Hey guys and girls, it's Nathan here from B.Invested headquarters. Today, talking a little bit more about how to retire in the GFD/scandemic, global financial depression. I quit my job in the middle of the GFC, the global financial crisis, back in 2009. I was 24 years old, retired from workforce with 25 properties. Now I own over 200 properties, and this is a very, very exciting time for me. A lot of people ask me, how can property prices rise? So how can prices rise? Very important question, and I want to go on to explain that today, how prices rose during the GFC and how I see them going through the GFD. So if we go back to Western Sydney in 2006, 2007, the property market in Sydney, a little bit of trivia for today, the property market in Sydney in 2004 hit a peak. It went backwards. So in Western Sydney, a house may have sold for 330K in 2003. These are some real numbers that I've pulled from properties that I was looking back at the time on. In 2007, these properties were 240, 250K. They had gone backwards. And in 2011, before everyone goes, the property boom happened, they were back to 330K, and then they eventually went to say like $600,000 to 650K. This is just an average sort of pool in say 2016. So what happened for these property prices to hit a peak, go down, go up, and get to the peak in the markets? What happened here is in 2003 we had stimulus packages, first homeowner grants, lower interest rates, trying to start with recession, we had baby bonuses and whatnot. In 2003 the Sydney property market saw a massive boom. 2004, 5, 6 and 7 the prices went down. Interest rates were 9% at the time. Average sort of bank rate at the time at RBA, there was 7.25% or 725 basis points. Hit a low point of 240,000 to 250. In the GFC, what we saw was a $14,000 first homeowner grant. We saw rates come down from 9% to 5%. We saw the RBA go from 7.25 down to 3%. Just put this here, RBA and the bank rate. So what happened is when we were coming through, we had a property crisis already in 2003. In 2007, it was at the bottom of the market. In and around 2008 to 2009, they did this. So 14,000 first homeowner grant. Interest rates came down. Lending improved. For those of you in 2007, 2006, remember, certain banks would only give you out a $10,000 cash out policy. I remember having over $1 million worth of equity throughout some properties, and the bank would only give me $10,000 and they'd want me to cross collateralize the properties. So for those of you that are whinging about the finance market being difficult at the moment, it's always been like that. It's been different levels of awkwardness and painful dealing with the banks. But these are some of the things that have occurred in 2008, 2009. What happened is, as they introduced the first homeowner grant, put a pent-up demand in the market. As the rates dropped from 7.25 to 300 basis points at the RBA, banks lowered their rates. It enabled for people to come in and service the properties. And what we saw was a lack of building going through that period of time. So if we look at the Sydney market in 2003, there are a lot of rental properties, a lot of vacant properties like we've seen since about 2016 to 2019 in Sydney. In this period of time, builders didn't build as much property. However, we needed to bring more immigration into the country. Therefore, we had a pent-up demand pushing that market up. So the market did go backwards, did go sideways. Introduction of stimulus packages in the market around 2008, 2009 brought the market up back to where it was. So if we looked at that on the chart, it would show that a period of 8 years the property did nothing, and if you look at it from this period to this period, it looked like it's gone up, and if you look at it from this period to this period, it certainly looks like it's gone up. But you need to look at the whole picture. in order to see what's going on and look at what triggers certain things to happen. I remember when I was working in a job, all my colleagues were on say 60 to 70k packages, and everyone was stuck and being able to buy a property for around that $300,000 to $330,000 range. So these properties were Penrith, Central Coast, Campbelltown, those sort of markets. And then after the GFC, these same people from 2011 to 2016, the property prices went up and sort of doubled. Why did they double? And that is the ultimate question of why we're here today with this video. Why they doubled is first time in a grant, gave some confidence to the market. Most importantly, someone that could only service on their 60 grand a year with salary at 300 grand can now service for more money at 5% interest rate. So as the rates went down, servicing improved. And that's basically what ended up eventuating into this market. So I'm going to wipe this off the board and I'm going to go through an example of something different in Sydney at the moment. So hopefully we've all on the same page with that. So how can property prices rise still, right? And I agree with a lot of the guys out there that are tinfoil hats and whatnot, trying to sell gold and silver and all that sort of stuff. But I want to look at it from a more holistic approach as to where we're sitting at the moment. So let's take an example of Kellyville. My office is here in Bella Vista in Sydney. Kellyville is not too far away. It's McMansion capital for those of you that aren't here in Sydney. Everyone's house is worth, say, $1 million. And incomes, you've got maybe like 2 incomes type of family, say 2 incomes of say 80 to 100k. So a household income of say 150 to 200k. If someone's on a household income of 150 servicing $1 million worth of debt, you know, things are going to be pretty tight out there. So the question I ask is, if someone's got a $1 million mortgage, how could that ever turn into a $2 million property if the people cannot afford it? And it all comes down to the same principles of what applied going back through the GFC. So the income's never changed, right? The people I was talking about beforehand with those certain properties, these people here, like I don't see someone's income going up from 80 to 160 grand anytime soon. I don't see someone's income going from 100 grand to 200 grand. So how in the hell can we get these prices? Well, the only way that it can happen is if something fundamentally changes. And a lot of people say that the property market's in a bubble, and it could be, right? People could see it from that perspective. But if you look at the whole market, it's not the property market that's in a bubble, it's the currency that we use, because as we have talked about in previous videos, debt becomes irrelevant with inflation, and you know, it's not the value of the property that's going up so much, it is the cost, it's the value of the currency that you're using. So you need more dollars in order to buy the same product. Hence why a paddle pop has gone from 80 cents to $2.40, because you need more of the currency. So here we are looking at the house, a typical household in Kellyville in northwest Sydney. That would be what someone would need to sort of get a loan there. So we could see these incomes double, but we're in the middle of a recession. So what do we have? We remember back in 2008, 2009, we had the first home in a grant, which went from 7k to 14k. We saw rates from 7.25% at RBA to 3% at the RBA, and the banks pass those cuts on. If we look at the market at the moment, what could trigger this off? Well, say a mortgage beforehand was at 5%. On $1 million, 5% would be $50,000 per annum in interest. Drop the pen, guys. So we've got, actually I'm going to write it here just just so we can draw one over to the other side. So we've got 5% interest, which would be $50,000 per annum in interest. So if someone's got 150 grand household income, they've got to take out taxes. That taxes goes from those two incomes, let's say 30 to 40k. So now they're on, say, 110k. They've got 50 grand to pay in their mortgage, and they've got 50 to 60k to live on. It's not that much. However, how in the hell could they ever pay more money? What they could do in order to purchase this property at this price is that if interest rates went down to 3%, the $2 million mortgage at 3% would equal $60,000 per annum. Right? At 2%, it equals $40,000 per annum. Right? So with this wave of debt that we are now seeing entering the marketplace, with the cost of money becoming cheaper or currency becoming cheaper that we're using, we are now seeing the ability for that same income family, without increasing their income, be able to purchase this asset by taking on more and more debt. So is this a sustainable model? I believe that we've got one more cycle in this process before the currency loses all value, and all currencies have. And the last 1,000 years, since 1024 AD was the first hyperinflation from a fiat currency. It was in China. We have seen over 10,000 different currencies throughout history that have lost their value due to hyperinflation. And we're at a point where we've far surpassed any of those currencies, but we've got so many different levels of manipulation in this system to keep pushing this down the road and kick it down the road. But I believe that we're losing the ability to do so. Hence why I call it a scamdemic, because we have a financial crisis here on our hands, and the floor is being mopped under the guise of a flu or virus. So I'm not going to get too much into that today. However, just wanted to share, for that house or property to go from $1 million to $2 million, this income I don't see increasing at this point in time. I do see the ability for interest rates for the same person that could service the $1 million could possibly service the $2 million in the future, depending how low rates go. The other aspect to look at is the job keeper. They've introduced universal basic income, UBI, basically an STD to the currency supply. Universal basic income, which is now $1,500 per fortnight, which people are getting. If that becomes a thing that has to stay, like as we saw with the first homeowner grant that came in for a little period of time and it stayed because the system now needs it to survive, that could be something that could help boost that income as well for us to see another property cycle. So if you're sitting here thinking sky's going to fall in, everything's going to cave in, world's not going to spin anymore, there is opportunities for them to still manipulate the currency supply for this to keep pushing forward. Ultimately, I'm not a big fan of buying these high-end sort of properties. That's why I've always talked about buying bread and butter properties. At the moment, as time of filming this, I'm picking up properties still for 150 to 350k is my favourite target range in capital cities around Australia. Remembering to make sure that we've got them cash flow neutral, have them below market value. So if shit happens like we're seeing at the moment, you've bought them where you've built a buffer in place, and you've got them where they're cash flow neutral, and you want to see them with the upside for growth. The reason why you want to see upside for capital growth is that when you see this all happen, you don't want to be in some little bumfuck town which has nothing going on there. So on that note, guys, we'll catch up soon. I've got a third video to show you, and we'll catch up soon. Have a great day. Bye for now.